Welcome back to the Deep Dive. We're the show that digs through stacks of sources, articles, research, you name it, to pull out the key takeaways for you. Today, we're tackling a really interesting one, the often, let's be honest, frustrating world of successful trading. Our main source is Jason Allen Jankovsky's book, Trading Rules That Work, the 28 Essential Lessons Every Trader Must Master. Solid stuff. But here's the twist. We're not just going to list rules. That's boring, right? Our mission is to get under the hood. We want to figure out the psychology, like why most rules just don't seem to click for the average trader, and more importantly, how you can actually make them work. Think of this as, I guess, your shortcut to really getting the interplay between market mechanics and your own head. We'll hit you with some surprising facts, some practical insights, and hopefully keep it engaging.
It's a really critical point you raised there because, well, the stats are pretty stark, aren't they? Something like 90% of traders end up losing money. Yet, like Jankovsky says, it's not like the rules are secret. We kind of all know the rules, right? So the real issue, the thing that separates the winners from the losers, it isn't really about knowing the rules. It consistently comes down to actually applying them, personally, consistently. And that's the hard part.
Okay, let's dig into that. Jankovsky and his editor, they literally asked that question, why don't the rules work? So what was the answer?
Well, fundamentally, it's because most traders don't really know how to use them effectively. It's not the rules themselves that are broken, it's the skill of applying them. He uses this great analogy from Edgar Allan Poe, the purloined letter.
Oh yeah, where the letter is hidden in plain sight.
Exactly. So the rules are like that. Cut your losses, everyone knows it.
Yeah.
But making it work for your specific trading style, your psychology, and then doing it consistently, day after day. That's the real challenge. It's hidden in plain sight.
Okay, so if applying the rules is key, we need to understand the playground, right? The market itself. Jankovsky really hammers this point about certain markets' futures, options on futures, Forex. He calls them zero-sum markets. What does that actually mean for a trader, and why is it so vital to get your head around it?
It means exactly what it sounds like. For every single dollar a winner makes. Well, a loser loses that exact dollar. It's a direct transfer. You make 10 grand. Someone, somewhere, just last 10 grand.
Ouch.
Yeah. The market literally functions so that the losers pay the winners.
Mm.
And when you remember that 90% statistic, 90% close their accounts at a loss, you start to feel the pressure, right? Everyone jumps in thinking they'll win, but most end up losing. It's pretty brutal.
So that paints a pretty grim picture. What does that reality mean for you, the listener, trying to trade?
It means the game you're really playing is, well, beat the loser.
Sounds like that JP Morgan quote. Anyone who is unaware of the fool in the market probably is the fool.
It's exactly that. So the biggest mistake traders make when they don't grasp this, it's failing to understand where the order flow is coming from. And maybe even more important, what to do if you find yourself on the wrong side of that flow. If you don't get the zero-sum part, you might think the market's just this abstract thing you pull money from, but it's not. It's direct competition. And 9 times out of 10, those other traders are the ones you need to beat.
Okay, key insight time. Trading in these zero-sum markets, it's direct competition. Your profit is literally someone else's loss, so you absolutely have to understand the order flow and know what to do if you're wrong. All right, so if the zero-sum game is the arena, the next step is equipping yourself, which brings us to rule #2, have a trading plan. What's the difference Jankovsky makes between a trading plan and a trading system? They sound similar.
They do, but they're really different. A system, he says, is about finding market inequalities,
Right.
like getting a better entry price. It's market analysis. But a plan is about you, the trader. It's you against the market, sure, but also you against yourself. It's the framework for how you behave. Like minimizing trading when you're losing, regularly checking if you're actually following your system.
Yeah.
And here's the kicker. It also needs to cover how to participate when you're doing well.
Wait, doing well can be a problem.
Absolutely. Big time. Success can be just as dangerous as losses if you're not prepared for it.
Oh, so?
Well, he talks about money getting bigger than your head.
Yeah.
You know, a new trader hits a lucky streak, makes a big chunk of cash,
Uh,
and confuses that luck with skill, gets overconfident, probably gives it all back, and then some.
okay, so the plan needs to address what happens when you're actually winning big.
Precisely.
Yeah.
What do you do when you're far enough ahead that it starts messing with your head?
Yeah.
He even gives personal examples, like scheduling non-trading weeks around his son going to Europe, or Oktoberfest.
Oktoberfest, seriously.
Acknowledging things like jet lag, personal distractions.
Yeah.
It's about managing yourself.
So the core message is your plan has to be deeply personal, factoring in your life, your temperament.
Exactly. It's proactive self-management, not just market signals.
Key insight. A trading plan isn't just about entries and exits. It's your personal roadmap for managing your behavior, capital, and psychology, crucially, during both losing streaks and big wins. Okay, so you've got this personal plan. That sets you up for rule #3. Think in terms of probabilities, which is tough, right? As humans, we want certainty. We get in the car, we expect to arrive safely. But trading, it just doesn't offer that, does it?
Not at all. It's fundamentally random. Any attempt to profit is really just, well, a best guess. You can never know for sure how a trade will play out. Certainty is an illusion here. The goal isn't finding certainty. It's about narrowing down your options to the best probability available. The basic hypothesis is simple. If the conditions look bullish and if other traders react like they should, then prices should go up. It's all about likelihoods.
And this links to that old rule, don't pick tops or bottoms, right? Because knowing the exact bottom versus just a bottom, that's a probability game.
Totally. You'll never nail the absolute bottom or top consistently in real time. It's about probabilities.
Yeah.
And he points to volume and open interest VOI as a really powerful clue for reading those probabilities.
How does that work?
Well, for example, say open interest drops while the market is falling, and you see that the buy orders are mostly shorts, covering their positions late.
Okay.
That's a strong signal that the sellers are losing conviction.
Right.
It suggests a potential bottom is forming. Your job as a trader isn't just analysis, it's finding the path of least resistance, and that's always a function of probabilities.
Key insight. Trading is about managing probabilities, not chasing certainty. Focus on finding the path of least resistance by assessing market conditions and crowd behavior, using clues like VOI, rather than trying to predict exact turning points. Understanding probabilities then leads right into rule #4. Know your time frame. This seems crucial, matching your own decision-making style to the market's rhythm. What happens when there's a mismatch?
Oh, it leads straight to emotional conflict.
Yeah.
Big time. See, everyone has a natural time frame, the amount of time you personally need to analyze, decide, and act. If your trading method doesn't match that, you're going to struggle. Too short a time frame for your style, you'll hesitate, miss entries. Too long, you get bored, maybe fearful, bail out too early.
Yeah.
Your methodology has to fit your character, otherwise it's just constant emotional friction.
That's interesting. And the market itself has all these different time frames operating at once, right? Like an hourly trader's small move might be nothing, just noise, to a weekly trader.
Exactly. It's like a cacophony almost if you don't have your own rhythm defined. Jankovsky gives this useful rule of thumb, the factor of 3.
Factor of 3.
Yeah. If you trade weekly charts, expect your trade's potential to play out over maybe 3 weeks. If you're on a 15-minute chart, maybe look for things to develop over 45 minutes. Your ability to actually hold a winning trade and let it run is directly tied to your chosen time frame. Trying to trade a daily setup while glued to a 5-minute chart, that's just asking for trouble. Emotional trouble.
Key insight. Align your trading time frame with your natural decision-making speed and emotional tolerance. A mismatch forces emotional conflict and undermines your performance. Find the rhythm that suits you. Okay, let's shift gears to something absolutely vital for survival, cutting losses. Starting with rule #5. Define your risk. This is often called the single most important skill. Why does Jankovsky put so much weight on this one? More than analysis, even.
Because defining risk is so much more than just setting a stop-loss order on your screen. It requires a really honest self-assessment of your actual skill, your willingness to even be in the game, like really understanding your expertise. Owning a gas station doesn't make you an expert in oil futures, right?
Right. Obvious when you say it, but...
Yeah. And it means facing personal stuff, too. How does your spouse feel about you trading? Do you need this capital for, I don't know, fixing the roof next month? It's the absolute foundation. If you haven't truly defined your risk, you're not really trading. You're just hoping. Gambling, maybe.
So the trap is thinking every trade has to be a winner, a home run, and that stops you from defining a potential loss up front.
That's a huge part of it. Defining risk is about protecting yourself by facing all the ways you could lose before you even place the trade, not just price moving against you.
Key insight. Defining risk isn't just a stop loss. It's a deep, honest look at your capital, your psychological limits, your actual expertise, and your life circumstances before entering any trade. And that flows right into rule #6. Always place a protective stop. But Jankovsky throws a curveball here. He says, stops are primarily profit management tools. How does that work? Isn't it about stopping losses?
It sounds weird at first, I know.
Yeah.
But think about it. If your initial idea, your hypothesis is correct, the market should move your way, right?
Big deal, yeah.
So The stop isn't really needed for risk management in that scenario. Where it shines is profit management. As the trade moves in your favor, you use the stop to lock in those gains. The mistake people make is rolling stops up too aggressively. Then they get nicked out by just random minor price wiggles, cutting their profits short.
Ah,
Stops only become true risk management if something fundamental changes, your initial idea was wrong,
yeah.
and you're suddenly accidentally on the wrong side.
Key insight. View protective stops mainly as tools to manage and lock in profits as a trade develops. If your initial analysis is sound, the stop shouldn't primarily be for risk control, but for securing gains. Okay, then rule #7. Your first loss is your best loss. This one really fights against our ego, our need to be right, doesn't it? Why is accepting that first loss so hard, but so vital?
It's hard because, at that moment of loss, the problem usually isn't the market. It's our attachment to our hypothesis. We want to be right. But the reality is most traders, even good ones, will have slightly more losing trades than winners over time. It's about the size of wins versus losses. So the less attached you are to any single trade being the one, the better your overall performance will be. It's actually freeing.
And that first loss, it's like a signal.
Exactly. It's the market shouting two things at you. One, get on the right side. Two, if you're not on the right side, get out. Now, it's like a megaphone saying you might be early or maybe just plain wrong. Time to reassess quickly.
Key insight. Quickly embrace your first loss. It's valuable market feedback signaling your hypothesis might be flawed or premature. Detach emotionally and use it to reassess, minimizing damage. That flows perfectly into rule #8, never friend. Add to a loser, the old, don't throw good money after bad. What's the psychological root of why traders do this? It seems so obviously wrong.
It seems obvious, but it happens all the time. It shows a complete failure to define risk in the first place. And it's almost always driven by the trader's emotional need. The need to be right, the need to fight the market, maybe even a desperate need to make back a loss or, make a car payment. It's never based on objective market conditions when you're adding to a loser. It's based on hope and ego.
He actually says we should reframe a losing trade, not just as losing money, but as a failure of personal discipline. So if you break a rule, act on emotion. Even if the trade is slightly profitable right now, you liquidate immediately. Why is that so important?
Because it's about correcting your behavior, not just managing the money. It forces you to learn how to participate correctly next time. It breaks the bad habit cycle.
Key insight. Never average down on a losing trade. It's driven by emotion and ego, compounding bad decisions. Treat rule violations as losses too, liquidate immediately, even if slightly profitable, to enforce discipline. And then, the big one, rule #9, don't overtrade. He calls this the defining symptom of a losing trader. What's really going on under the surface here?
It usually boils down to a couple of things, either not understanding your proper time frame like we talked about, or just flat out not following your rules. It's almost always a symptom of emotional attachment, chasing losses, trying to make up for mistakes, fear of missing out. The cure: you need a baseline for your behavior based on your system and plan. Then you have to honestly ask yourself, am I trading more aggressively than my plan allows? It requires asking tough questions like, how well do I really know what I'm doing here, and am I willing to admit when I don't?
Yeah, reframing it as don't overcommit helps too. Nobody has infinite capital or infinite mental energy. You gotta focus.
Exactly. Quality over quantity. Always.
Key insight. Overtrading stems from emotion and poor discipline, not strategy. Focus on high-quality setups that fit your plan, respect your time frame, and conserve your mental and financial capital. Okay, let's flip the coin now and talk about letting profits run. Starting with rule #10, keep good records and review them. This sounds like homework, but he says it's the path to profit. Why is record keeping so non-negotiable?
Well, think of it like this. In school, you study the textbook, right? In trading, you write the textbook, you need to read through your records.
Well, like that.
You need to track the obvious stuff, entries, exits, stops, P&L, dates. That's the outer behavior. But the crucial part is documenting the inner data. Your thoughts, your emotions, fear, greed, hope, your perceptions during the trade. This lets you see what you actually did and felt, not what you wish you did or thought you felt. It's objective self-analysis.
And that hard data lets you see patterns, right? Like, oh, I always bail on winners too early when X happens, or I tend to revenge trade after Y type of loss.
Precisely. It's the only way to become your own coach and fix the behaviors that are costing you money or limiting your gains.
Key insight. Detailed records, including your thoughts and emotions during trades, are your most powerful learning tool. They provide objective data to identify and correct behavioral patterns hindering your profitability. Then we have rule #11. Add to your winners. This feels counterintuitive after talking about cutting losses, but it's key for maximizing gains, right? How do you do it smartly?
Right, it's the flip side of risk management. Adding to winners is really the best way to let profits run, because a trend, that net order flow, can go way further than you initially thought. But you need to be proactive. The time to add is when the market strongly confirms your original idea, when your certainty is highest. A really good clue is seeing volume pick up on days the price moved in your favor, especially if open interest is also rising.
Why is that combo important?
Because it signals new money coming in, new buyers and sellers engaging. It shows the move has conviction, has fuel left in the tank, not just old positions closing out.
Key insight. Systematically add to winning positions when market action confirms your initial hypothesis, especially with rising volume and open interest. This proactively maximizes gains by riding sustained order flow. Now, rule #12, use multiple timeframes. We touched on this, but how does understanding the interplay between different timeframes specifically help you let profits run longer?
Because your best, longest-running trades happen when you catch a move that aligns across multiple time frames. Think about it. If your short-term buy signal gets confirmed by the hourly chart, and then the daily chart also looks bullish.
More and more traders are seeing the same thing.
Exactly. That brings in more buying power, more cumulative order flow, pushing your trade much further than just a short-term setup could alone. And here's a cool, slightly complex idea he mentions. Sometimes a shorter time frame needs to give a little counter-trend signal.
Like a pullback.
Yeah, exactly.
Yeah.
To kind of entice the opposite side traders to jump in thinking it's a reversal.
Oh.
But their entry orders actually become the fuel, the initiation for the bigger, higher time frame move in your original direction.
Wow, okay. So you learn to use the smaller wiggles to ride the bigger wave.
You got it. Learn to let the larger time frames push your trade. Be patient.
Key insight. Maximize profit potential by aligning trades across multiple time frames. Confirmation on larger time frames signals broader participation that can significantly extend your winning trades. Next up, rule #13. Know your profit objective. This is about discipline exits. How does setting a target beforehand help you actually hold on to a winner?
It's huge for maintaining discipline and the right risk-to-reward ratio. He talks about those magic numbers again.
Yeah.
To have a low probability of ruin, you need something like 42% winners with a 2.1 profit-to-loss ratio.
Right, the win rate alone isn't enough.
Exactly. So having a profit objective before you enter helps you aim for that 2.1 or ideally 3.1 reward to risk. It also gives you the mental strength to sit through and wait out temporary adverse price moves like little pullbacks that shake people out because you know what you're aiming for. You have a reason to hold.
So it's not just a price target, but a way to gauge if the trade is still on track towards a worthwhile reward compared to the risk you took.
Precisely. It provides context and keeps you focused on the bigger picture.
Key insight. Set clear profit objectives based on a favorable risk-reward ratio, aim for 3.1. This provides the discipline to ride out minor pullbacks and ensures your winning trades significantly outperform your losers. And the last one in this section. Rule #14. Don't second-guess your winners.
Oh man, this is tough. That urge after a good run to just grab the profit or even reverse. Why is that so dangerous?
It's incredibly tempting, isn't it? But you risk shorting a bull market, essentially. You have a good long position, it runs up, you get nervous, take profits, maybe even try to short it, expecting a pullback.
Yeah, only for the original trend to resume without you. Or worse, you get stopped out on your short and miss the rest of the big move. You end up whipsawed.
So sticking with your initial winning idea, even when it feels uncomfortable, is crucial for hitting those bigger wins that make up for the small losses.
Absolutely. This rule supports all the other let profits run rules. It's about having conviction in your analysis and being willing to potentially hit the home run. Markets are big places. Trends can go much further than you initially expect. Don't cut them off at the knees.
Key insight. Resist the urge to prematurely exit or reverse winning trades. Trust your initial analysis and allow profitable trends to fully develop, avoiding whipsaws and capturing potentially larger gains. All right, let's move into what Jankovsky calls trader maxims. Starting with rule #15, know the limits of your analysis. This feels like a direct shot at how many people view technical indicators. What's the big myth he busts here?
The big myth is that technical analysis is predictive. It's not. It's historical. That chart on your screen with all the indicators, it looks exactly the same as everyone else's chart looking at the same market.
Right.
So if everyone sees a buy signal and jumps in, well, someone has to be selling to them, don't they? The illusion comes when a trade works out. We think, the analysis worked. But when it fails, we think, Oh, I must have done the analysis wrong.
But the analysis itself has limits.
Exactly. He states the surprising truth. Most technical analysis methods, on their own, have a success rate somewhere between 38% and 52% for predicting winners.
Basically a coin flip.
Basically. It's only useful when you combine it with understanding the underlying net order flow, what the crowd is actually doing.
Key insight here. Technical analysis maps history. It doesn't predict the future. Its real value comes from revealing crowd behavior when combined with understanding order flow, not from its standalone predictive power, which is near chance. Okay, that leads nicely to rule #16, trade with the trend. Sounds simple, but there's a nuance about which trends might be more reliable, especially in zero-sum markets.
Right. Trends happen, uptrends, downtrends, ranges. But he makes the point that generally downtrends in these markets tend to be more secure, more profitable. They can run for a long, long time. There's that saying. A bull has to eat every day, but a bear only needs to eat once in a while. Meaning uptrends need constant buying fuel. Downtrends, well, gravity works. And importantly, any bull market in a zero-sum game will eventually be followed by an equal or even greater bear market.
And why do markets break faster than they rally?
Because the selling pressure can be way more intense. You can have three sources of selling: hedgers selling into strength, speculators opening new short positions, and existing long holders panicking and liquidating.
Triple threat.
Yeah. So if you're long, you need to be way more vigilant.
Key insight. Always align with the prevailing trend. In zero-sum markets, be aware that downtrends can be more powerful and sustained due to potential triple selling pressure, requiring extra caution on long positions. And this ties right into rule #24, all markets are bearish. Wow, that's a statement. Here, these bull markets in these zero-sum environments are basically aberrations. Can you explain the role of the hedger here?
Sure. And again, this mainly applies to zero-sum markets like futures, not equities or Forex. The hedger is someone using the market to offset real-world risk. Think a farmer selling futures against his upcoming crop.
Okay.
That farmer never has to buy back his short futures position if he doesn't want to. He could just deliver the actual grain.
Ah, right.
So speculators like us, we have to offset our positions eventually. And it doesn't always. They are the natural sellers at higher prices. They need bull markets to sell into, to lock in prices. They use rallies to protect themselves. This creates a natural downward pressure over the long term.
So the market structure itself leans bearish because of hedgers consistently selling into strength.
In these specific markets, yes. That's the argument.
Key insight. In zero-sum futures markets, the structure inherently favors bearish moves because hedgers consistently use rallies to sell and transfer risk. Bull markets are temporary deviations fueled by speculators. Let's talk rule #17. Use effective money management. This isn't just about position sizing, is it? It connects back to understanding who's actually taking the risk.
Exactly. Markets are fundamentally designed for hedgers to transfer their risk onto speculators, onto you. Knowing when hedgers are most active, when they're keenest to transfer that risk, gives you huge clues about when it's smart to allocate your capital and when it's maybe better to sit out. Remember, low returns go to those who avoid risk. Higher potential returns go to those willing to take calculated risks.
And the biggest risk is being on the wrong side of that hedger flow.
That's the ultimate risk, being on the wrong side of the net order flow, especially the institutional or hedger flow. You want to trade with them, or sometimes strategically against the speculative crowd when the hedgers are doing the opposite. The key is preserving your capital until those high probability moments arrive. Risking maybe 1.5% of your balance per trade is a common guideline.
Key insight. Effective money management involves understanding the market's risk transfer dynamics. Align your trades with or against hedger activity, preserve capital, and risk only a small percentage, figure 1.5%, on high probability setups, which makes rule #18. Know your ratios absolutely essential. Trading as a business needs a balance sheet. What are those magic numbers again, and how do they help?
Right. Good records let you calculate your key performance ratios. This shows your real strengths and weaknesses. The magic numbers he highlights for having a low probability of blowing up are 42% winning trades, combined with a 2.1 average profit-to-loss ratio.
So winning more often isn't enough if the losses are too big.
Not at all. Your winners must be significantly larger than your losers, on average. That 2.1 ratio is key. Consistency is the goal. He gives that great example of the trader who crunched his numbers.
Yeah.
Found out he made money Monday to Wednesday, but consistently lost it all back on Thursday and Friday.
Wow. So what did he do?
He changed his rules, maybe traded smaller or not at all on those losing days, and boom, his overall results improved dramatically. That's the power of knowing your personal ratios.
Key insight. Treat trading like a business by tracking your performance ratios. Aim for at least 42% winners A&D and average win size twice your average loss size, 2.1, to minimize your risk of ruin. Use this data to tailor rules to your specific patterns. What about rule #19? Know when to take a break. The markets will still be there tomorrow, right? Yet traders get obsessed.
Oh, definitely. There's this manic energy sometimes, this fear of missing out, FOMO. But look at top performers in any demanding field: athletes, CEOs, surgeons. They prioritize rest and balance. Stepping away clears your head. It preserves your mental and emotional capital, which is just as important as financial capital for making good decisions. Avoid burnout.
And it's not just about trading performance, it's about life, right? Health, relationships. You don't want to win at trading, but lose at everything else.
Exactly. You need that balance for sustainable success and, frankly, happiness.
Key insight. Regular breaks are crucial. Step away from the screens to maintain mental clarity, avoid burnout, and preserve the emotional equilibrium needed for optimal, objective trading decisions. Okay, rule #20, don't trade the news. We all know, buy the rumor, sell the fact. But what's the psychology that makes trading news releases so tricky?
It's the immediate emotional reaction it triggers, especially in less experienced traders. News creates this powerful urge to action.
Right, you gotta do something.
Yeah. But often, the smart money, the winning traders, are doing the opposite. They're liquidating their positions into that news-driven buying frenzy, selling to the newcomers. This is why you often see that weird reversal right after a big news announcement. The price does the opposite of what the news suggests.
So what's the advice?
Wait at least an hour, maybe longer, after the news hits. Let the dust settle. Don't chase the initial spike. Remember, the market is usually already priced in the expectation of the news. What matters is how the market actually behaves after the news is out. That tells you the real story, the market's interpretation.
Key insight. Avoid trading immediate news releases as they trigger emotional reactions. Smart money often fades the initial move. Wait for the market's post-news behavior to reveal the true interpretation and avoid getting caught in reversals. Next, rule #21. Don't take tips. This sounds straightforward, but Jankovsky argues the problem isn't the tip itself, but something inside us. What does he mean?
He means that when you act on someone else's tip, you're giving up your own thinking, your own responsibility. You're essentially just gambling on their opinion. Even relying solely on a technical indicator someone else developed is, in a way, taking a tip from the developer. The only real data that matters for your trade is the decision process inside your own head, your choice to execute based on your plan and analysis. Taking tips makes you dependent.
And he makes the crucial extension, don't take tips also means don't give tips. Why is giving advice potentially damaging to the giver?
Because suddenly you feel obligated to defend your analysis.
Right.
You get into these emotional debates with people who aren't objective. It becomes about opinions, not disciplined trading. It drains your energy and focus.
Protect your own process.
Exactly. Foster that intellectual self-reliance.
Key insight. Reject all trading tips and avoid giving them. Acting on external advice undermines personal responsibility and critical thinking. True success comes from executing your own well-reasoned plan. Rule #22. Withdraw equity regularly. This is about turning screen profits into actual wealth. Why is taking money out so psychologically important?
It connects back to classic wisdom, like from the richest man in Babylon. Always pay yourself first. Set aside a portion of your earnings. Trading success isn't just about the number in your account, it's about what you do with those profits.
Yeah.
Regularly withdrawing some money helps break the emotional attachment to the account balance. It stops you from thinking, oh, I have more capital, I can risk more, or getting reckless and giving back gains. It makes the profits real.
And it reinforces the why, right?
Yeah.
Using some of those withdrawn profits for things you enjoy, travel, hobbies, whatever keeps you motivated and balanced. It makes the hard work feel worthwhile.
Absolutely. It creates a positive feedback loop. Good discipline leads to profits. Profits lead to rewards, which reinforces the discipline.
Key insight. Make profits tangible by regularly withdrawing equity. This builds real wealth, reduces emotional attachment to account size, prevents overleveraging, and reinforces disciplined trading habits. Let's tackle rule #23. Be a contrarian. This isn't just doing the opposite of the crowd, is it? It's more nuanced.
Much more nuanced. It's fundamentally about understanding crowd psychology. Knowing that once everyone who is going to buy has bought, or everyone who is going to sell has sold, Well, the only thing left for them to do is the opposite to get out.
Right, they have to reverse eventually.
So your goal as a contrarian is to anticipate that turning point, to position yourself just ahead of that change in the net order flow. Usually that means buying when the selling looks most intense, or selling when the buying looks most euphoric. Lots of people can call a market direction, but they fail to profit because they don't understand when the crowd is likely exhausted and about to turn.
So it's about exploiting the crowd's emotional extremes without getting swept up in them yourself.
Precisely. It requires clear thinking and the courage to act against the herd's momentum.
Key insight. True contrarianism is anticipating shifts in crowd psychology and positioning yourself just before the inevitable reversal when sentiment reaches an extreme. It's trading against emotional momentum. Okay, a very practical one. Rule #25. Buy-sell 50% retracements. Simple, he says, but potentially very profitable. What's the basis for this if it's not Fibonacci?
Yeah, he's very clear. This is not about Fibonacci, who he calls an alchemist, not a trader. The insight comes more from people like W.D. Gahn, who study time and price relationships. The 50% level, and sometimes 72%, represents a natural point of equilibrium or balance after a move. Think of it as the market pausing to catch its breath, balancing the buy and sell orders before potentially continuing the trend. It's historical observation, not prediction. But when you combine looking for entries or exits around that 50% pullback level with other rules like trading with the trend, #16, adding to winners, #11, not second-guessing, #14, it becomes a really powerful, high-probability tool.
Key insight. The 50% retracement level is a simple, effective tool based on historical price-time balancing, GAN, not Fibonacci, for identifying potential consolidation points. Use it in conjunction with other rules for high-probability setups. This leads right into rule #26, the only indicator you need. Thinking back, traders used to operate with much less, just intuition and crowd knowledge. What's the single indicator Jankovsky argues reveals the most?
Right. He acknowledges technical indicators can be useful, but they're limited, they lag, they're historical, and complex black box systems. They often miss the most vital element. What is the crowd actually thinking and doing? The one indicator he says you really need is volume and open interest, VOI,
We mentioned this earlier. Why VOI specifically?
because it directly reflects crowd participation and sentiment. Is money flowing in or out? Are traders confident or fearful, hopeful or despairing? Rising open interest with rising price suggests new longs and new shorts are entering with conviction. Falling open interest on a rally might mean shorts are covering, running out of steam. It shows the conviction behind the price moves.
So it's like reading the market's internal energy level, not just the price.
Exactly. It's an art, for sure, learning to read it. But it reveals changes in market structure, the depth and nature of the game. In a way, price alone, or lagging indicators, just can't. It tells you how the price got there.
Key insight. Volume and open interest, VOI, are paramount because they reveal the crowd's true participation, sentiment, and conviction, the how and why behind price moves, unlike lagging indicators. Okay, rule #27, study winning traders. There's so much info out there, gurus everywhere. How should you focus your study?
The crucial distinctions between studying trading systems, the specific methods for picking trades, and studying trading itself. Trading itself means learning how to avoid common pitfalls, control your own behavior, manage risk effectively. You can have the best system in the world, but if you trade it poorly with bad habits, it's worthless. So focus on how winners think. How do they handle losses? How do they manage risk? How do they maintain discipline? That's more valuable than just copying their entry signals.
Reading biographies of successful traders seems like a good approach here. See their struggles, how they overcame blowouts, how they learned to apply knowledge effectively.
Exactly. It's about absorbing their wisdom, their mindset, their journey, not just their indicators. It's the difference between knowing the theory and having battlefield command.
Key insight. Study successful traders to understand their mindset, risk management, and behavioral discipline, not just their specific entry-exit systems. Effective trading habits trump system mechanics. And that brings us to the final and maybe toughest one. Rule #28, be a student of yourself. Why is self-study the ultimate foundation?
Because everything filters through you. Price just moves. It just is. Your interpretation, your reaction, your decision, that's all personal, unique to your psychology. Until you can separate your own thinking and behavior from the herd mentality, you can't see the crowd objectively. You'll just be part of the crowd. Most traders lose precisely because they think and behave like everyone else. So to succeed, You must become a detached observer of your own mind. Recognize your biases, your fears, your moments of greed or overconfidence. Notice what leads to good decisions and what leads to bad ones. It's about, as he puts it, lifting the veil of illusion about yourself.
That sounds hard. He talks about forced awareness, like hitting rock bottom, blowing up an account sometimes being the only way people finally confront their own issues.
Sadly, that's often true. The choice becomes stark. Hang on to your illusions or hang on to your money.
Any practical way to start this self-study without blowing up?
He suggests simple things like using note cards. Write down questions. Am I just hoping right now, or is this trade based on my plan or emotion? Keep reminders visible. The market doesn't know or care about my position. Constantly challenge your own thinking. Check your confidence levels. Overconfidence is just another illusion. It's about cultivating relentless, honest self-awareness.
Key insight. The ultimate trading skill is self-mastery. Continuously study your own thoughts, emotions, and biases to separate your actions from the losing crowd's behavior and cultivate objective, profitable habits. Wow. Okay, so wrapping this all up, the core message from this deep dive seems crystal clear. Your trading success or failure, it really originates inside you. Every single one of these rules, in some way, points back to detaching from outcomes, accepting that anything can happen, and understanding that the crowd usually gets it wrong.
Exactly. The less emotional energy you waste judging yourself or the market or trying to force things, and the faster you just admit you're wrong and cut a loss, the more mental space and capital you have for the trades that do work. It really puts the control back where it belongs with you, the trader.
It's like these rules are the syllabus for the class you have to take, the education you need to actually make money consistently in this game. So here's a final thought to chew on, especially if you're newer to trading. Next to defining your risk, maybe the most immediately impactful rule is rule #21. Don't take tips. Why? Because it forces you, from day one, to rely on your own thinking, your own process. It makes you block out the noise. And blocking out that noise might be the single best thing you can do to avoid getting completely derailed early on. So think about it. Which of these insights resonates most with you? How can you start applying them right now to better understand that link between the market's moves and your own mind?